Now let's take a look at the categories, shall we? Canada's favorite pastime, real estate.
I'll take real estate for 1,000, please, Alex.
This word is derived from a law French term used in Britain in the Middle Ages meaning death pledge and refers to the pledge ending, aka dying, when either the obligation is fulfilled or the property is taken through foreclosure.
What is a mortgage?
Correct.
After hearing that, if you weren't already scared of mortgages, you definitely are now. The word literally comes from the term death pledge, which is why so many people refer to getting a mortgage as signing your life away. However, mortgages have also been a tool that the majority of the rich have used and continue to use to build wealth. But the key is having a strong understanding of what a mortgage is and how to pick the best one for you. That's why in today's video, we're shedding light on the complexities of mortgages, providing you with a straightforward explanation of everything you need to understand about securing a mortgage. This includes breaking down terms that often confuse homebuyers, such as closed, fixed, and variable rates, among other crucial details. A mortgage, in its simplest form, is a loan specifically for purchasing a property. Imagine you found a home priced at $500,000 and you're able to provide a $50,000 down payment. The remaining $450,000 that you need to secure the home is what's known as a mortgage. However, the process and considerations become a bit more complicated if your down payment is less than 20%. In such cases, mortgage insurance becomes a requirement. This insurance is provided by one of three organizations in Canada. These consist of CMHC, or the Canada Mortgage and Housing Corporation, which is the most recognized and is government backed, 𝐫𝐨𝐽, formerly known as Genworth Financial, and Canada Guarantee. The specific provider of your mortgage insurance isn't of significant concern, as their offerings are relatively similar, so there's no need to worry about that. However, it is crucial to note that this insurance is designed to protect the lender, not you, in the case that you fail to keep up with making your mortgage payments. For those who are able to afford a down payment of more than 20%, mortgage insurance isn't a requirement. Although you might need to cover the cost of an appraisal, which typically ranges from $300 to $500. But this is a small price compared to the potential mortgage insurance premiums that could otherwise add up to several thousands of dollars. There are essentially two types of mortgage rates available: fixed and variable. A fixed rate mortgage keeps your interest rate constant through the term, offering stability and predictability in your payments every month. On the other hand, a variable rate mortgage can change based on the prime rate set by the Bank of Canada, potentially offering savings over the long run, and historically has done so. However, you do need to keep in mind the inherent risk of fluctuating rates, which can go higher as well. If you're concerned with interest rates rising, fixed rate mortgages are probably a better option for you, as you're protected from your rate going up over the term of the mortgage, which would lead to higher payments. This is often the case for those on a fixed income, and especially if your finances are already tight. Variable rate mortgages, on the other hand, are more popular when interest rates are falling, and for those who are okay with the potential variability. So this can be a better option for those with variable income and more flexibility in terms of their finances. Something to note though is that if you do choose a variable rate mortgage and rates do begin to rise, there's always the option to switch to a fixed rate mortgage at current rates, subject to certain conditions. Another important concept is amortization. This is the total time it'll take you to pay off your mortgage in full. For insured mortgages, the maximum amortization period is 25 years, whereas for uninsured mortgages, it can extend up to 30 years. However, the Canadian government has actually just recently made a change, and starting on August 1st, 2024, insured mortgages for first-time home buyers will now be allowed to have 30-year amortizations for new construction and pre-sales. So depending on when you're seeing this video, you may have the ability to do so. So essentially, the amortization is what determines your payments, as the longer your amortization, the lower your payment. Now, the amortization is different from the term of your mortgage, which refers to how long your interest rate is set, whether it's a fixed or has a variable discount. The term of your mortgage can be anywhere from 6 months to 10 years, with the most common option being a 5-year term. Once your term is up, you may be able to renew your mortgage loan with a new term and rate, or pay off the remaining principal. And of course, for most, you're just going to be renewing your term. In terms of a fixed rate mortgage, it's the amount of time that you get that fixed rate guaranteed for. In terms of a variable rate mortgage, it's the amount of time that you have the discount guaranteed for. So in a variable rate mortgage, if it's priced at prime minus 0.5% or prime minus 0.1%, that discount will be guaranteed for the term of the mortgage. So for example, let's say 5 years. Now, if the Bank of Canada adjusts their key lending rate, obviously the key lending rate, or prime, will change, but your discount off prime will stay the same. When it comes to payments, you have the flexibility of choosing how often you pay as well. There are two main types of payment plans for mortgages: unaccelerated and accelerated payments. Unaccelerated payments are generally made on a monthly or semi-monthly basis, although they can also be structured as bi-weekly or weekly payments based on how the lender organizes the payment schedule. On the other hand, accelerated payments are usually set on a weekly or bi-weekly basis. It's crucial to specifically request accelerated weekly or bi-weekly payments. If you only mention wanting weekly or bi-weekly payments without specifying accelerated, you might end up with unaccelerated payments instead. To figure out if you're on an accelerated payment plan, a simple method is to take the amount of your monthly payment and cut it in half for bi-weekly payments, or divide it by 4 for weekly payments. If your bi-weekly or weekly payment amount matches one of these calculations, then you're on an accelerated payment plan. If the amount is lower, then your payments are not accelerated. We strongly advise anyone buying a home to opt for an accelerated weekly or bi-weekly payments. Although both options offer similar benefits, there is a slight advantage to choosing weekly payments over bi-weekly by the end of a 25-year mortgage period. But the difference is quite small, just a couple of $100s over the 25 years. Therefore, whether you choose bi-weekly or weekly payments should depend on what suits your financial situation best. We prefer weekly payments as it helps better managing cash flow, ensuring a small amount of money is dedicated to your mortgage each week rather than a larger sum every other week. Next up, let's talk about the difference between open and closed mortgages. An open mortgage is best suited for those who plan to pay off or prepay their mortgage without worrying about prepayment charges. It allows you the freedom to put prepayments towards the mortgage loan anytime until it's completely paid off. An open mortgage may have a higher interest rate because of the added prepayment flexibility and can be converted to any fixed rate term longer than your remaining term at any time without a prepayment charge. Examples of when this would be the most useful is if you sell your home, if you get a substantial salary bonus or commission, an inheritance, or another type of financial windfall. You have the ability to use that money to pay off your mortgage early and pay less interest. Conversely, with a closed mortgage, you have the flexibility to increase payments and or make lump sum payments within certain limits according to the features of the particular mortgage. If you want to pay your mortgage loan off completely before your term ends, prepay more than the maximum allowable amount, or pay off your mortgage balance before the end of its term, prepayment penalties may apply. However, a closed mortgage typically has a lower rate than an open mortgage for the same term because of the flexibility that it allows. When you're in the market for a mortgage, it's a must to get pre-approved first. Pre-approval can be categorized into two distinct types: fully underwritten and non-underwritten. Pre-approval processes that instantly give you a pre-approval status within minutes without requiring essential documents like your job letters and pay stubs fall under the non-underwritten category. These quick pre-approvals are generally not as reliable. On the contrary, a fully underwritten pre-approval involves a thorough check of your employment documents, pay stubs, and other necessary paperwork to provide you with a precise pre-approval amount. And this meticulous approach to pre-approvals is definitely the method that we suggest. When it comes to securing a mortgage, we strongly advocate for working with a mortgage broker. Brokers offer a broader range of products and options for lenders, giving them a massive edge over individual bank offerings. While banks excel in managing your day-to-day banking needs like savings and checkings accounts, a mortgage broker can help you secure the best mortgage terms and rates, ensuring you get a deal that perfectly fits your situation. Often, people find that the most suitable mortgage for them comes from a different bank than the one they usually do business with. And don't get me wrong, banks have their areas of expertise. Some may offer excellent mortgage options, others may be better for checking accounts, and some might shine in the investment sector. The key is to find a mortgage that suits your specific needs, and more often than not, this means looking beyond your regular bank. Remember, a mortgage payment is just a regular withdrawal from your account, whether it's monthly, bi-weekly, or weekly. The important part is ensuring you've secured the best mortgage product for your situation. And if you're interested in further exploring the topic of whether a mortgage broker or a bank is better for your situation, I have a previous video that you can check out right here. I'll also leave a link down in the comments so that you can watch it as soon as you finish this one. Moving on, lenders evaluate a few critical aspects when considering a mortgage application: your credit score, your down payment, and your income. These factors help them determine how much they're willing to lend you. Additionally, the property itself is scrutinized because it serves as collateral for the loan. Lenders prefer marketable properties paired with financially reliable borrowers. If you're aiming for a pre-approval, especially one that's fully underwritten, the simplest route is to apply online through the link provided below through one of our trusted professionals. For those who aren't quite ready to take the plunge but want to get an idea of what they might qualify for, I've also included a link to an online mortgage app. This tool can give you a snapshot of potential qualifications and rates before committing to a pre-approval. If you're thinking about buying or selling in the near future in my marketplace of Surrey, Langley, and the rest of Greater Vancouver, and you want to get some tailored advice based on your unique situation, you can click the first link in the description and book a buyer consultation, seller consultation, or just a general discovery call with me at a time that works best for you. And if you're ready to explore mortgage options, or just curious about what you might qualify for and don't already have a mortgage broker you plan on using, send me an email and I'd be happy to provide you with some top-notch recommendations. Don't forget to subscribe to our channel for more insightful content, and if you do have any questions, leave them down below in the comments. Thanks so much for watching. Make sure you check out another video on our channel before you get out of here, and we'll see you in the next one.